before I have another problem with the recording. Gotta check it out. The sound is working. Stream's working. Everything's working. Beautiful. Can I get a sound check like, real quick? Hey, Fabio. Oh, 1 second, guys. All right, let's begin. Recording is on. Beautiful. I don't want to have another problem with OBS this week. All right. Welcome to class number 6, you guys. This class is named Market Maker Model Series Part 3. So, in today's class, I'll be diving into the following stages of the market maker model. And in the previous classes, as you might remember, um, I was showcasing the stage 0 and the first stage. So let's make a recap before I dive into the following stage. Initially, stage 0 is what we call lowest buy and sell. Let's remember what it is. So lowest buy and sell happens when price returns back to original consolidation or smart money reversal before making the move, and this stage considered as lowest sell or lowest buy because due to its nature of having the least amount of invalidation, right? And on the buy side of the curve, it's the same thing. Price accumulates, forms smart money reversal, breaks out, and after that breakout, it retests the original consolidation, which we call return back to original consolidation or return back to smart money reversal, and it is considered stage 0 or lowest buy in the market maker model. So the key things about first stage 0 is it begins once the smart money reversal concludes, and this stage marks the price moving away from its consolidation, right? The breakout, that's the confirmation with SMT divergence or trapped positions. So low risk buy and sell opportunities can be used by utilizing any ICTPD array, and price may or may not experience a pullback to its original consolidation. So stage 0 in the market maker model is not mandatory. It doesn't have to happen. But if it happens, you know you know what's going on, which is why I'm covering this stage of the market maker model. As I said earlier, it's considered low risk mainly due to it is the very early stage of the expansion leg. And our primary objective is to define the smart money reversal range and anticipate a retracement back into that range, right? And if price retraces more than equilibrium of the smart money reversal range, the odds are against you because market gets into high resistance liquidity round. So ideally, you don't want to see return back to original consolidation below or above. Depends on the profile. Below or above equilibrium of that accumulation range. Let's take a look at the first stage accumulation and first stage distribution. So as you might remember, the first stage refers to the first expansion leg after smart money reversal, right? The first leg. The first blue box on the buy model and the first red box on the sell model. And in this phase, what happens is after the initial breakout of the consolidation, it expands, right? The lowest buy doesn't have to be there, but if it's there, it expands afterwards. And the first retracement after stage 0 is the first stage accumulation on the buy side, buy profile, right? And this retracement will be back into either range equilibrium of the last expansion range, or it's going to be in the buy profile into discount PD array. And that PD array can be anything really. It doesn't have to be a fair value gap. Here's a chart example from the last class. Smart money reversal, breakout candle, right? Price accumulates right above the original consolidation range high, rallies one more time. So that rally, that's one, from range low to range high is the expansion leg. Now its dealing range becomes the framework. So the PD area over there, you see the fair value gap is first stage accumulation in the form of a fair value gap. After that, price rallies higher, completes the first stage objective, which is internal range liquidity. On the south side of the curve, accumulation, retracement, the first retracement after the breakout is where the first stage distribution happens, right? It retraces back in the PD array. On the higher time frame, this price action usually forms an order block in this leg. So the anticipation of that order block is highly important if you remember before executing on the first in the first stage. Got to be able to anticipate that kind of order block on the higher time frame. So as you can see here, it moves away from the consolidation and retraces back into a PD area, which in this case it was a fair value gap CE, becomes the first stage distribution. And the entire retracement you see here on this time frame is an order block on the relatively higher time frame, and then it distributes lower, completes the market maker sell model. And lastly, the objective of this stage, as you remember, is either to trade into range equilibrium, so to reprice the market to range EQ, or take out internal liquidities along the way. Also, fair value gaps are also considered internal range. And the key takeaways from about the first stage is this can be initiated basically utilizing any ICTPD area, just like low risk buy and sell stage. And the first stage starts before internal range liquidity gets attacked, right? That's I think that's very important part about the first stage. You have this formation, the stage starts before the internal range or range equilibrium gets tagged. So the reason behind this this timing is that internal range high or low becomes a breaker block for later stages, which I'll be covering this more today in this class. And the first stage of lower time frame market maker model is always a pullback on the relatively higher time frame. Thus, the first stage is usually not the most energetic move because of that. When engaging in trading during the first stage, it is important to anticipate the formation of the relatively high time frame order block prior to executing any trades, because failure to do so may result in bad executions, meaning because we are usually day trading, we have like tighter stop losses and you might get wicked out or something like that if you cannot anticipate an order block on the relatively higher time frame for the first stage. And the primary objective of the first stage of market maker model is either to trade into range EQ or take out the internal range liquidity, and that completes the first stage. This is highly important for the following stages, and I'll be talking about this more moving further today. Now let's dive in. This is the deal for the class today's class. Stage 0, second stage. I'm sorry, second stage reaccumulation and redistribution. As you remember, accumulation stands for price expansion towards the buy side, and distribution stands for price expansion to the downside. So you'll be seeing that more in the sell model, sell profile, and buy model for accumulation. Now, what is the second stage distribution and second stage reaccumulation? It's essentially the second expansion leg of the market maker model, and the objective of this leg, this expansion leg, is to complete the model itself, meaning the original consolidation will be targeted for this leg. And remember the price delivery of the market of the algorithm. So consolidation, which is original consolidation, expansion, right, and retracement. Now, this is the key part for the second stage, because this retracement and how it retraces will be very, very defining to understand the second stage, right? Then price expands in the same direction, which concludes the second stage, and that expansion will usually ends up with the liquidity purge, original consolidation, high or low, and completes the market maker model. Now, the reason I'm talking about this is mainly because there are different types of second stage deliveries, and I'll be talking about it in a bit. And to be able to understand the differences of these two distinct type of second stage, we have to look at how the first expansion and how the retracement took place in. Okay, now it sounds confusing right now, but when I get to the visuals, it'll be clearer. So, what is the second stage? Let's talk about that. The second stage is it represents the second phase of expansion towards the drawn liquidity. In this case, drawn liquidity is always the original consolidation, high or low in the market maker model. So during this stage, market pullbacks are exceedingly rare, and as the movement tends to be predominantly one directional. So this stage is the most energetic stage of the market maker model. And the second stage follows the completion of the first stage, right? It's going to happen only after the first stage completes its objective, which is the internal range liquidity, and the anticipation of that completion is it's going to be highly important to understand the differences between different second stage deliveries, and which I'll be talking about in a bit. So the primary objective becomes the primary objective of the initial stage is the internal range liquidity, or rebalance the imbalances, right? Or reprice the market into range equilibrium. So prior to the second stage, a retracement occurs. This is a must, okay? You're always gonna have a retracement back into either discount, range equilibrium of some sort, and that will set the stage for second stage. It's not gonna go one directional, like it's not gonna remember the price delivery. It's never expansion after expansion after, you know what I mean? It's always like a retracement. There's a structure in the market. And retracements create that structure, or reversals creates that structure, right? So there's retracement forms once the first stage has concluded, right? Not before. Remember that I always tell you this, like market maker models, whether it's the first stage or second stage, there is always an objective, okay? And that objective must be concluded. So before it completes its objective, whether it's the first stage or not, it is not going to retrace or reverse, okay? So this is the important part. After the completion of the first stage, there are two distinct types of retracements, right? We're going to be looking into these different types of retracements. So the first one is a retracement towards the market maker model's premium or discount levels, meaning the dealing range from original consolidation to smart money, that dealing range. Okay, this is the type one, and I call it. You'll see it in a bit, but this is usually the strongest second stage formation. This is my favorite one. And the second one, the second retracement, is towards the range equilibrium of the first stage expansion leg. So from from the order block to expansion leg high becomes the first stage expansion leg, and its dealing range is going to be the framework for this type. This is type 2. This is not the strongest delivery, but it's there. It's still there. So because of that, our main objective is to understand the initial stage, the first stage, and to anticipate its completion, right? Because otherwise we'll be induced of the idea of like price retracing or whatever. However, if you don't know whether the first stage is completed its objective, you might be stopped, or your idea might be invalid or wrong. The second stage is the most dynamic move within the market maker model. Okay, it doesn't matter which type it is, but the second stage is always the most energetic. And by primarily focusing on the second stage only, profitability can be achieved as well, so you can only trade second stages as well. Given that the second stage is primarily anchored around market maker model drawn liquidity and the first stage expansion leg, there's typically enough time to build a narrative. Meaning, if you can spot the market maker model from smart money, reversal, the breakout, then you'll have enough time to make your game plan, build your game plan for the second stage, because you're going to be waiting for the first stage, and in the meantime you can anticipate a lot of things. like a lot of things. You can see a lot of things. Where there comes the patience. Second stage reaccumulation. This is another important part. And redistribution may or may not necessitate SMT divergence. So it doesn't have to. You don't have to see an SMT divergence in this stage. Okay, and this will differ based on the delivery of the first stage leg. So we'll be looking more into how the first stage expansion leg delivered and then anticipate whether the second stage requires an SMT divergence or not. Let's take a look at it. So second stage reaccumulation. Okay, so second stage reaccumulation refers to the second expansion leg within the bioprofile. This phase embodies the most energetic and one-directional expansion leg within the market maker model. The initiation of the second stage reaccumulation occurs after the completion of the first stage accumulation, and it begins with a retracement. Okay, so that retracement is usually the manipulation, and it starts with that. Okay, because essentially the idea is that retracement creates an order block. Okay, and that order block will be the safe. In this case, this is an accumulation safe low for the second stage reaccumulation. So any invalidation, any violation of that retracement becomes an invalidation. So various types of retracement set the stage for the second stage, and each type of retracement necessitates a distinct approach to the marketplace. So you'll be looking at the marketplace differently whenever you see the different types. Just like the smart money reversal, right? There are two types of smart money reversal. One, traps. Second one, the traditional one with SMT divergences. And our approach usually differs based on the type, right? Same deal here, which I'll be talking about shortly. So the retracements can be into any ICT PD array, as always. So let's take a look at an example here. So this is the bioprofile reaccumulation. What happens here is the smart money reversal forms here, price consolidates and breaks out from that consolidation with SMT divergence at the lows, right? And after that, we see a retracement, return back to original consolidation. This is the lowest buy, state 0, and expands one more time, right? Retraces. That retracement is first stage, like first stage entry, right? And then it expands one more time. For now, first stage is completed. Why? Because the internal range liquidity has been targeted right now, right there, right? Now you can say, okay, the first stage has completed its objective. Now let's take a look at the second stage. What you need to do here is you need to establish a range, right? Which is smart money reversal to first stage range high. So this becomes your expansion, the whole leg. And then you look at its discount array or equilibrium, right? And you get another retracement. So the retracement into that discount array or range equilibrium may or may not break the structure like this one right there. This is the trap, okay? A lot of times, because people don't look at the marketplace in the context of market maker model, they usually take that as a structural shift or whatever. However, what happens is market maker models always has to complete its objective, right? This is the second stage retracement. So that retracement becomes the second stage, reaccumulation, trading into discount, and it rallies from there on, right? This becomes the second stage reaccumulation in the form of a fair value, like in the form of a fair value gap. Put a fair value gap here, but it could be any kind of PD array. Okay, so if you don't understand the market maker model and the framework, you might get burned thinking that this is a structural shift. Okay, now let's take a look at it on the chart and see how it looks. All right. So what happens here is price accumulates down here, creates smart money reversal, right? Breaks out of that range. With that breakout, it confirms the reversal, SMT divergence at the lows, in a retracement back into original consolidation, which is the red shaded box here, is the lowest buy, return back to original consolidation, state 0, and then price expands from there, creates another expansion leg here, there's a fair value gap right there, becomes the first stage reaccumulation and expands higher, Now what happens is with this expansion here, the whole move, the objective of that whole move becomes the internal range liquidity, like to take out that internal range liquidity or trade into range equilibrium, right? Before that happens, you can't say the first stage has fulfilled its objective. Okay, you gotta wait for that. Now, after that completes its objective, it retraces down into an order block here. You see that? That order block becomes the second stage accumulation in the discount array. And then price reprices the market above original consolidation buy side. Now I noted this as a like with red because sometimes you might miss that kind of price action because you might think like it just rejected the liquidity level and it might retrace deeper. What you can do is you can wait for structural shifts or some sort. So the next expansion here creates a fair value gap. You can also use that as your second stage reaccumulation entry. There's nothing wrong with that as well, which is why I annotated both here. Now, like last week, I was mentioning that you got to stay fluid or you got to be open-minded when it comes to trading market maker models because there's going to be a lot of things and different ways to trade this kind of model, right? Some people will see the order block, some people will miss that, some people see the breaker blocks or fair value gaps. So it'll be really personal. What you need to do is you need to backtest and forward test all this information and see which one is easier for you. Okay. Let's take a look at second stage redistribution here. Let's take a look at the sell profile now. Second stage redistribution refers to the expansion, the second expansion leg within the sell profile. This phase embodies the most energetic and one-directional expansion leg, just like reaccumulation within the market maker sell model. The initiation of the second stage redistribution occurs right after the completion of the first stage distribution, and it begins with a retracement. Okay, the retracement has to be there always. If you get confused about that, just pull that price delivery and see how price delivers. Okay, expansion, retracement, expansion in the same direction. Second stage redistribution also has various types of retracements that sets the stage for the second stage, and each type of retracement necessitates distinct approach to the marketplace. Okay, I'm going to differentiate the different types, and I'm going to show you how you should be approaching these types of retracements. Now, these retracements also can be into any type of ICTPD array. Let's take a look at a visual here. Sell profile visual. Price accumulates, creates smart money reversal with SMT at the highs, right? Then it breaks out to the downside. Retraces back into original consolidation. Lowers sell. Expands in the direction of the liquidity. Retracement direction. So this retracement becomes the first stage distribution. Its annotation is wrong. First stage distribution here expands and takes out the internal range liquidity. Once that internal range liquidity is engaged, now you can say first stage distribution has been completed. Now you can look for the second stage redistribution. Okay. After that, price retraces. Where does it retrace back? So you have expansion leg high, expansion leg low, right? This becomes the expansion, the whole move becomes the expansion, and return back to or retrace back to its premium or equilibrium becomes the second stage, right? Now this retracement becomes the second stage redistribution, and price sells off, takes out the sell side. I need to change this. I need to fix this chart because there are a lot of the wrong things. This is not a discount fair value gap. This is not a second stage reaccumulation. It's a second stage redistribution. Takes out the low and goes for the sell side and completes the market maker model. And usually, just like on the visual, the second stage redistribution or reaccumulations will literally looks like this, like one directional, boom, it attacks the sell side or the target drawn liquidity and completes the market maker model. Now let's take a look at the chart example. Smart money reversal, SMT divergence at the highs, price breaks out, right? retraces back into range after the breakout. Now that retracement becomes the lower sell in the form of fair value gaps CE that expands one more time. Retracement into another fair value gap here becomes the first stage distribution, right? And then it rallies lower. So in that rally, what happens is it trades to range equilibrium or below it, right? It did not engage with the internal range liquidity in this case, but it broke below the range EQ. That means the first stage is finished now, right? And then price moves back into premium array, fair value gap here. That becomes the second stage redistribution. So here, what I'm looking at is I'm looking at the market maker model's range. So from original consolidation to smart money reversal high, I'm looking at that range, and I'll tell you why in a bit. And then price trades into that fair value gap and sells off, reprices the market to the sell side. Now here's the same chart with a different approach. So if you look at this price action here, you can also wait for the internal range liquidity to say the first stage is completed, right? So you can wait for that purge and then look for a second stage. So in that case, what you need to do is you need to establish different PD areas in this the most recent leg. So what I see here is there's a thick price action, right, before the expansion, thick price action, which has to be respected to stay in a low resistance liquidity run to the downside. And also any trade above that thick price action becomes a sentiment change in the market. So it'll be either starts a buy model or starts consolidation. And since second stages has to be a low resistance liquidity run or the fastest move, it has to stay below it, right? So when I look at this thick price action and below it, what I see is there's a fair value gap or IFPD fair value gap because there are multiple. And there is another premium fair value gap here, right? So price retraces back into those PD arrays and sells off. You can consider that as second stage redistribution as well. So what I'm essentially saying here is it really depends on your own approach to the first stage that'll allow you to execute on the second stage. So in this case, if you were to say the aim of the first stage is to reprice the market to the range equilibrium, you can trade this as your second stage. But if you patiently wait for internal range liquidity, then you can trade the following price action, right? And that becomes your second stage. There's nothing wrong with either or. They're equally the same. Now, let's talk about the types of the second stage. Now, this one is the type 1, as I call it, power shot. I love this name. So this type is called, I call it power shot just because this type has the most dynamic delivery of the second stage. It is one directional, it has clean order flow, and it doesn't require a lot of attention whatsoever. So it's really one shot, one kill. Now, power shot delivery indicates strength in buy profile, weakness in sell profiles. Price will keep its low resistance liquidity run. Because of that, it will not violate any thick price action prior, just like I mentioned in the previous example. The primary distinction between power shot and type 2 lies in the first stage delivery and the retracement preceding the second stage. Okay? So essentially, you're going to be looking at how first stage delivery happened, and you're going to build the story around the second stage type or types around that. Okay? And I'll show you how. In a power shot scenario, the first stage does not contain a significant consolidation. This is the key part. So the first stage is usually one directional, no consolidations whatsoever, right? And in those cases, the second stage becomes type 1 power shot, second stage delivery. So the retracement observed in this type typically occurs within the market maker model's dealing range discount or premium. Because of that, the framework for the second stage or power shot has to be built around market maker model's range, okay, dealing range. So what I mean by this is essentially, if I go back to this example, when the power shot type is occurring on a price action, what you need to be looking at or building your framework around the market maker model's range from high, smart money reversal high, to original consolidation low. Okay. Now on type 2, we're going to be looking at something else, and that's what I mean, and it's very important. That's why I underlined it and it's in red. So power shot represents the most energetic form of second stage delivery and always one directional. As a result of that, entry criteria for power shot might or might not be aggressive entry. Okay, you can wait for structural shift, or you can aggressively enter as well because it's going to be a fast move. So the last pullback, the last manipulation, will usually be a wick, and it will run right away. And power shot instances, power shot type does not require an additional SMT divergence before it pans out. Now let's take a look at an example to clear some confusions here, because I know this sounds a lot at the moment to you, but you'll understand it better when you look at this. So what happens here is we have a sell profile, right? Original consolidation. Then we have trap longs, which is a type of smart money reversal. Price breaks out from there, so then retraces back into that range here, which becomes the lower sell, return back to original consolidation. Then expands in the direction of the drawn liquidity, retraces back again, and in that retracement, there's an order block here, 2 up close candles. That becomes the first stage distribution, right? Then it expands lower one more time, taps to the range equilibrium, and what that tells me is the first stage is just being completed now. Now, if you look at the first stage high and second stage, first stage high and the completion of the first stage, you'll see it's one directional. There's no consolidation or choppy price action whatsoever, right? Now, because of that, what you can do is you can anticipate quote-unquote power shot second stage redistribution occurrence. Right? What I mean by that is you can expect a stronger second stage delivery. And for that, what you need to do is you need to be looking at the market maker model's framework. Okay? And what happens is it breaks down, so it creates a thick price action after the first stage is completed. The reason for this thick price action is basically because it is securing the highs here, right? It's going to be a high resistance, liquidity around anything above that price action, so it's securing. The highs above the thick price action you see here is a safe high. So it distributes lower, retracement. So the first retracement into market maker model's range premium becomes the second stage redistribution in the form of power shot, because the first stage was one directional, and then it sells off and reprices the market to the original consolidation. So what happens here is, or what you need to look for to understand the types of the second stage is essentially, first of all, you gotta wait for the first stage completion. Once that's completed, you look at that price action and you say, was it choppy or not? Was it one directional or was it sloppy a little bit? Right? You got to answer that question. In this case, it was not choppy, it was one directional. Then what happens is power shot will never violate any thick price action prior, because market wants to keep its low resistance liquidity run condition. So you're not going to be seeing more manipulations in the power shot model. Because of that, this type of second stage does not require an additional SMT divergence at the highs whatsoever. Okay, market or the algorithm will want to reprice it rather fastly. I'll get to questions in a bit once I'm done. So retracement will be into market maker model's dealing range, right? Premium sells off, and no additional SMT is required. Now, the second type, I call this catfish because the purpose of this type of second stage delivery is a fake out. So it fakes out the structure, it fakes out the market structure shift, and it indicates a high resistance liquidity run. So you're going to be seeing more like choppy price delivery on the first stage. Okay, so catfish delivery is rather choppy delivery in the first stage, and followed by a deep retracement into first stage range equilibrium. So for this type, what you're going to be looking at is the dealing range of the first stage instead of the dealing range of the market maker model. Okay, that is the main difference. And in this case, you're going to be seeing deep retracements. So because the retracement is deep, this type of second stage initiation usually traps and induces traders. They tend to think the order flow is changed or has changed already. Because of that, again, the primary distinction between the power shot and the catfish comes down to how the first stage was delivered. Was it choppy or not? So in catfish scenario, the first stage tends to deliver rather shallow and slow and contains significant consolidating price move. You're gonna see this better in the chart example in a bit. Now this is the most important part. The retracement observed in this type typically occurs within the first stage dealing range. Okay, so you're going to be looking at that framework and its discount and premium. Because of that, the framework for the second stage, catfish, has to be built around that expansion, like instead of using the market maker model's uh, dealing range. So catfish delivery is also as energetic and as power shot. It is again uh, very energetic and one directional because it's the second stage. Market will want to reprice it above or below original consolidation as soon as possible. And because of that, the entry criteria may or may not be aggressive. Okay, meaning sometimes you should not or you won't wait for lower time frame confirmation on the second stages. You will enter aggressively at range equilibrium or whatever the case is. Now, catfish instances require some T divergences due to its uh, due to its condition of being high resistance liquidity run. Okay, usually this occurs in the afternoon session or New York session end of day. What happens is usually people call end of day pump or end of day dump. This is usually what happens. So price waits or consolidates within its first stage, then it manipulates through the end of the day into the first stage discount or premium, and rally really fast becomes the second stage. So let's take a look at an example here so you guys can understand it better. So what you see here is original consolidation, or let me put it this way. This is the price action from Friday. It was a good example, so I put it down here. What happened here is there's a smart money reversal here, SMT divergences, and market broke out from the range accumulation, right? Then my eye goes to the original consolidation, potential target for the market maker buy model. What happens here is it expanded higher, right? Retracement down into an order block. So this fair value gap, because there's an order block here, I'll zoom in a little bit. You'll see it better. Or you know what? Let's zoom in. Or never mind. I'll keep it for later. So this has to be breakaway gap initially because there's an order block here. So what happens is it expanded first, retraced down into an order block, becomes the first stage accumulation, right? Now you wait for the internal range liquidity is taken out here, right? That becomes the first stage. Now, if you look at the price here, until it gets up to the internal range liquidity, it's going back and forth too much. It's kind of like choppy, right? It's not one directional. At the end of the day, or eventually, it takes out the internal range liquidity, completes the first stage. Okay, that is the important part of understanding first stages. You got to anticipate its completion. Because think about it, when you watch this live, you don't know whether that's the objective or not, right? And that's the hardest or trickiest part. So once it's completed, what you need to look at in this type, because it's choppy, first stage expansion high, and this is the expansion low, you need to look at this dealing range now instead of looking at the market maker model's dealing range. So from the low of the smart money reversal to first stage expansion high, there is the first stage range equilibrium. You see that here. And what happens is once it completes the first stage, it starts retracing back down into its range equilibrium and or discount. In this case, it retraced all the way down into discount fair value gap, discount PD array, formed an SMT divergence, which is required for this type. This is the catfish, and then it rallied and completed its buy model. So this touch into discount fair value gap and SMT divergence becomes the second stage reaccumulation in the form of catfish, just because the first stage was choppy or sloppy. Okay, and usually for second stages, because it's one directional, it, almost all the time, almost every time, it requires rather aggressive entry. So the way to trust aggressive entries is it comes down to understanding different stages of the market maker model. So if you know that this touch is the second stage reaccumulation, you would trust catching that knife, if that makes sense. That rallied higher. Now you'll get entry criteria here as well, because they're like, for example, there's an order block, there's a breaker block, etc. You can enter in those PD areas as well. There's nothing wrong with that, but you're going to be missing moves quite a lot, because sometimes it's not going to give you entry at all for the second stage. Now this is the same price action. I just zoomed into the buy side of the curve. You'll see better the order block, which makes the lower fair value gap here, breakaway gap. So price uses that order block to rally higher and complete the first stage, internal range liquidity. Takes out that. Once it takes out that, then you establish the dealing range of the first stage from this high to low, and look at its range equilibrium. And also look at if there are any important or significant PD areas below its range EQ, because that's what's going to happen. It's going to retrace back down there before the second stage reaccumulation pans out. This is the catfish model, and this requires SMT divergence all the time because of its nature of high resistance liquidity run. This is dense stuff, guys. I'm aware that it's not, I'm not expecting you to understand it right away. In fact, I think you guys should be rewatching these videos later on, and then start backtesting it all. So let's take a look at the key takeaways. The second stage reaccumulation represents the highest probability and the most energetic price move within the market maker model framework. You have enough time to build a narrative behind the price moves until the second stage forms. So if you go back here, what I mean by that is essentially before price gets into the second stage or its second stage, you have this much of time to build your game plan in the market, right? Which gives, in my opinion, it gives clarity to mind, because you're not rushing into anything, you know what I mean? Like, you stay calmer, which is the biggest advantage of trading only second stage, in my opinion. So the two distinct types of second stages exist: the power shot and a catfish. These are names I called it. You don't have to use that, obviously. The ability to comprehend and anticipate which type may occur lies in the nature of the first stage delivery. So you got to understand how it delivered. If it delivers fast for the first stage, that sets the second stage as a power shot. And in that power shot, first of all, it doesn't require an SMT divergence, and the framework becomes the market maker model's framework itself, right? And for catfish, the first stage delivery is rather choppy, and the framework becomes the first expansion dealing range. So if first stage is high resistance liquidity run, expect catfish, and conversely, if it's low resistance liquidity run, expect power shot. This is like the simplest way I can put it down. Given that the catfish type often involves highly manipulated price actions, additional divergence, SMT divergence is required, and this completes the last manipulation before this second stage, before the energetic move. For power shot instances, the anticipation is that price referring to market maker models dealing range, whereas for catfish, price relates to first stage expansion legs dealing range. I hope you get the difference there. So power shot deliveries are always they always respect the thick price action prior because since because of because of its nature of being low resistance liquidity run, it is not going to manipulate further after smart money reversal. Now here's an example of complete market maker model. This is I showed this last week as well without the second stage. This is the hourly chart of Nasdaq from last week. So this is a very good example, which is why I'm reusing it here because it literally shows the whole model in terms of the buy side of the curve is there, sell side of the curve is there in one chart, and the difference is also there. One targeting an imbalance to reprice the market, the other targeting the liquidity to purge the liquidity, right? They're always both present in terms of market maker model because the idea of the model or behind the model is it will either target the imbalance or liquidity, and that's it. My favorite is targeting the ones that are targeting liquidity. It's easier for me to navigate through. That's why I'm mainly using that. But anyways, let's take a look at it. What happened here was so price initially sold off, then it starts stalling, right? So it went into some sort of consolidation. That consolidation formed a smart money reversal and S&T divergence. Then broke out of that range, confirms the consolidation or the reversal. So it initially expanded, then returned back to original consolidation with these candles. That return back created an order block here. Here I draw it in time. Price retested it. Bodies are respecting, so the wicks are permissible. It became the first stage accumulation. Then it rallied one more time, created a fair value gap, and that fair value gap was used for second stage reaccumulation. Then price traded into an imbalance here, and it started consolidating. It starts stalling, which means the buy side of the curve has just completed its objective. So at the end of the day, its objective ended up being targeting the imbalance. And in that consolidation, it consolidated above BC, meaning this became trapped longs once that BC was inverted with this candle, so the breakout candle. And in that breakout candle, there's an advanced, this is more advanced lower sell, return back to the fair value gap, the initial target of the buy model, sold off from there, traded down into market maker model's dealing range, which is the dashed trend line you see here. Then retraced from the EQ, retraced back into inversion fair value gap CE, became the first stage distribution, and it sold off. So in that expansion lower, there's a breaker block here, and some portion of that breaker block is also in premium. So after first stage targeted at the internal range liquidity here, right there, it retraced back up to premium of the breaker block's upper portion. And from there it sold off, which became the second stage redistribution, and it completed the sell profile, repriced the market below the sell side. Now, I annotated this as a power shot for a couple of reasons. First of all, if you look at the first stage, which is this high, to internal range liquidity, the wick that targeted the internal range liquidity, it's one directional. It's not chopping around there. So it becomes the low resistance liquidity run first stage distribution. So you can expect a power shot second stage. Now, to build a narrative about around power shot, you got to look at the dealing range from original consolidation low to smart money reversal high, right? So you got to wait for that narrative to build, to form first, back into trade back into premium and sells off, okay? And this sell off does not require SMT divergence or further manipulation. This is very dense stuff, not going to lie. Here are my closing remarks about overall market maker models. The model framework presents the highest probability trades and targets, in my opinion. And in instances of uncertainty regarding like which high or low to target, market maker models provides exceptionally accurate narrative and bias. Because here's the narrative. So you have a bias here that it'll reprice the market to the sell side, but what's the narrative? So this retracement becomes the narrative, and you can build that around the market maker model, because if you know the second stage will be power shot, which means price should retrace back into market maker model dealing range, EQ or premium before the sell off, that becomes the narrative. Then you have your bias and you have your narrative. You can either, trade the narrative or wait through the narrative and trade the bias. So it gives you a lot of options. So market maker model serves to streamline and simplify price action. You get to understand why price moves, manipulates, and all that once you understand the whole different stages of the market maker model, different types of different deliveries, etc. And the model helps to optimize, helps optimization of execution timing, because especially this is so true for first stages, especially if you're trading that, because if you can anticipate order blocks on the first stages, then your timing becomes flawless essentially. Market maker model is an invaluable model in position management as well. Once you understand different types and stages of the model, you'll get to know where to put your stop loss during a position or when you're in a position, because you'll know when to expect manipulation, when not to expect manipulation. So viewing price action through the market maker model perspective allows us to remain flat during consolidations. This has a lot to do with SMT divergences, and or remember the market maker model profiles. Whenever the original consolidation gets targeted, the price gets back into consolidation again for a while. So that in that way you can also anticipate the consolidations. Market maker model helps us to anticipate consolidations and high resistance and low resistance expansions. And that comes down to the types of second stage delivery. Now, before getting into trading exercises here, I'm gonna take questions. And I hope I'm recording. Yes, okay, beautiful. So Nazmi, it's your question first. Is it better to um, wait the EQ break for the second stage? Uh, I think this was the. Let me take a look at it here. Okay, so you're asking, is it better to wait the EQ break for a second stage? That really depends on the price action. Personally, the safest thing to do is to wait for the internal range liquidity. That is the safest. But there's nothing wrong with like waiting for range EQ as well. How we can know if it's going to break through the original consolidation, because sometimes it's bouncing back. You look at intermarket. That is your answer, because if price, I mean, we had this a couple days ago, um, this day actually, on Friday. What happened was So this is Nasdaq chart. Nasdaq traded into, essentially this is smart money reversal in the form of trapped shorts, right? So it traded into this consolidation and it couldn't violate. So this swing low failed to break below it. And in the meantime, what happened was ES made a lower low here. So ES was trading below these lows. That indicates what? SMT divergence. That indicates strength in Nasdaq, if that makes sense. And that in that way, you can understand whether it's gonna go break, whether it's gonna break below or not. The safest thing to do is if price is like in a close proximity to original consolidation, you look at the other asset. If that asset has taken out the original consolidation already, that's your cue to dip your position. Is it possible to anticipate catfish looking at the opposite side of the curve? For example, if it seems choppy or thick price action, the other side, then can we expect the same on the other side? That is a great question, and I do not have an answer to you. But it's very likely. I gotta look at it, look into that myself first before answering that question. But it's very likely. Let me see. I mean, these are just a couple of examples. I gotta look at the broader spectrum, but it's general rule of thumb. It's very likely, like I said. Oh, I'll look into that. I'll look into your question. It might be very powerful if that's true, also, and it also makes it easier to understand whether, because sometimes some people will say this is not a consolidation. That's kind of objective as well. But anyways, second stage, one will SMT and other will soup the low. We'll explore that. Wait, I didn't understand anything you wrote. So you're saying like second stage one will have, so catfish will have SMT divergence, yes, and the other one, if you mean by the other one the power shot, yeah, I get you. This one does not require SMT divergence. I don't know if that's what you mean. And the reason is this stays in the low resistance condition, right? It's not violating the thick price action. It like the market will do everything to just stay in the low resistance condition in this occurrence. On the other hand, on the other one, it is already in high resistance. You know what I mean? And because of that, price will manipulate around liquidity again, which manipulation, what I mean is essentially the smart SMT divergence is a manipulation. It runs the lows. This is the manipulation. It essentially becomes a turtle soup also. So I forgot to read this. Um, so in the catfish second stage, what happens is the first stage is completed after internal range of liquidity purged here. Then look at the first stage delivery. Initially, it was energetic, right? Then it starts stalling, but at the end of the day, it completed it, right? So what you need to do is you look at that first stage and ask yourself, was it choppy or does it look like it is in high resistance liquidity run or not? If so, catfish second stage is in play to complete the market maker buy model, which is what happened today as well, actually. I mean, I didn't watch it that much, but like I took a peek on the 5 minute today and it looked like a catfish second stage. So what happens here is retracement is expected to be into the first stage expansion dealing range, equilibrium or discount. an additional SMT is required because we're anticipating catfish. What do you call it when or horizontal consolidation is not taken out, price return before getting there? I call it swing failure. So here you see it, there's a consolidation. This is trapped shorts. Price fails to break below it. So I call this swing failure. And it also creates SMT divergences usually. Catfish also seems to have three Indian pattern. What is three Indian pattern? Never heard of that before. Market's been so choppy that this is all I've seen in the last 3 months. Can we can we review the price action today? I can take a look at it like really quickly because I gotta go in like 20 minutes or 30 minutes or so. But like, I can take a look at it. Oh, three drive pattern. That's not always the case though. So I would not rely on that honestly. It happens, but not all the time. Um, yes. Okay. Let me clean this a little bit. So, I don't know if you guys were in yesterday's stream, but I was mentioning this move, this run. I said like I see that as a manipulation. I think price is drawn into at least range equilibrium um of the sell model on the hourly chart here. This is the original consolidation. Essentially, I want to see original consolidation sell side, but it seems like this is the first stage here. Retracement back into BPR or fair value gap here. I see that as a first stage, and now it completed its objective, which is the range equilibrium, right? That's how I saw it. And this is where we opened New York session. So I'm going to go down to a lower time frame here. So initially, market opened 9:30 candle here, manipulated lower. That became the Judas swing because at the same time, if you look at ES is not running below the lows here. See that? That creates what? SMT divergence. So once this consolidation is broken out, so here the SMT divergence. So what that indicates is once price breaks out of this range here. Now why am I taking from there? If you ask, if you look at the bodies, they're like expecting more. So what happened here is it broke out of that range. You can take from here too if you want to. It's not wrong. And this fair value gap became the lower supply. At the same time, once the smart money reversal is there and confirmed, my eye goes to here and maybe here as well. Could be target. This looks like a higher probability though. Here becomes the original consolidation. Took that out actually. Right there. So on ES, the same level is here, which hasn't been taken out. But that does create. So that's an SMT divergence. Now can it take it out? Yeah, it can, obviously. Because this could be another here, horizontal consolidation. That could be the essentially that could be the target as well for the buy side, right? So in that case, how I see this is essentially first stage or lowest sell, lowest buy, right? The fair value up here, right there, becomes the first stage accumulation. The rallies higher, takes out the internal range high here, retraces back into another fair value gap, right about here. And this fair value gap ended up being used as second stage reaccumulation, and market buy model is being completed here on the 5 minute. Can you please upload the weekly review? Missed the beginning. Did not? Have I not? Let me see. I think I did. Okay, no, I haven't. Okay, I'll post it today for sure. Sometimes for dry pattern. Today's price action was choppy. Expect the last 2 hour. Yeah, I mean, here's the thing though. The only thing you could have done today is essentially this is range equilibrium, right? At range equilibrium on the hourly chart, so you got to look at it on the hourly. It's already respecting with the bodies. What does that tell you? It is algorithmic, right? That's algorithmic delivery. So if you know that, once the New York opens here, let me go on the 1 minute. So once New York opens, once you can see the SMT divergence at range equilibrium, which is point of interest to go along, you can buy the first fair value gap on the 1 minute. And you can hold your position here to original consolidation, which is a very, very generous return, I mean. Because that's essentially a buy model, 96 points. Oh. Go back to 5. 5 is cleaner today. Go back to 5 and see what's going on. Yeah, this is how I see it honestly. Like internal range high got rejected there. Again, algorithmic delivery. This is also range equilibrium of the original consolidation equilibrium, which got rejected. Retracement back down. So essentially, this is an order block. Hold on, let me delete this. These down close candles on this leg becomes an order block essentially, right? You can use that as second stage, because what that tells me is the lower fair value gap here, this portion, is a breakaway gap, or it should be a breakaway gap until the original consolidation gets tagged. So that is your long for second stage. Here, this order block, or a fair value gap also, you can use that too. But this is 5 minute though. Let's go down to 1 minute and see what happened there. Yeah, the 5 minute original consolidation is much cleaner when you think about it. But here, I would say, I could take this for the 1 minute target. It's the same level, really. Zoom in. Something like that. So SMT divergence here, sharp return, didn't even accumulate below, right? Which indicates bullishness. And there's the first fair value gap, got tested, and it rallied from there on. This is IFED. So essentially, if you're using IFED fair value gap here, you're buying into discount of the hourly range. So it used the range equilibrium to bounce from there. This becomes the first stage, I would say. I mean, you don't see it on the 1 minute though, but that rally from there. What I'm, what I was thinking when I looked at it in the like almost through the end of the day, I think I sent this chart on in general chat. Hold on, I gotta stop recording because otherwise.